All right, so welcome to another video. Today, what we're going to do is we're going to go ahead and check out 4 chart reading mistakes that you might be making. So as we go in, there's a lot of chart reading mistakes that people get into, but I just want to pinpoint a couple of more common ones, and that's what we'll cover here in this video and episode. If you do want to go ahead and grab some more additional insight, check out our website at tradersfly.com. There's a ton of live classes that we do, a lot of them also on options, which you can also check out our options channel at Tradersfly, and you can see we just do a ton of different material. You can also join the Discord channel right here. There's a ton of great people in here, and I'll also answer some questions. I'll post some stock movers here as well throughout different days or throughout the week. So anyway, let's kick things off. I want to share with you some thoughts on these chart reading mistakes and just give you some tidbits on it because I see this happening a lot of times in the marketplace. So as we start going into this, one of the first biggest mistake that I see is that people get bullish when there's really no trend in sight. So for example, are you going bullish, but you are maybe in a choppy market? Do you see a clear trend, or are you in a market that has distribution? Going bullish when there's no clear trend is difficult for new traders. And I want to pinpoint a couple of different stocks here for you just in the recent time frame. So if you're looking at this maybe later down a year or two after the video is made, you can probably spot some of these types of some of these areas. So let's go into the chart here, and we're going to go ahead and look at Adobe here. So what happens is people try to go ahead and go bullish, and they're trying to go bullish like right now. They might see a few of these pops to the upside, but it's a little bit choppy right here. So you're also going with a downward trend, in fact. So when you're looking at things right here, we've got some sideways action. So this is sideways consolidation. And people attempt to go bullish or during the sideways consolidation. Now, you can do that. And I think this is a more aggressive stance. So it's totally fine if you want to be more aggressive and you're looking for the breakout. But just understand, be a little more careful. If you're new, people go wrong here. If you're more advanced, you know, it's totally okay to do that. Just understand this is more aggressive. The sweeter or cleaner approach would be to wait for when this trend actually breaks through, comes back and retests. So you have one opportunity on the break, one on the retest, usually if it does retest, and those are usually a little bit more cautious approaches. If you take a look at Alibaba as well, and you go bullish right here, well, take a look at this trend. If I just look at this moving average, this is a moving average, I believe it is the 50 moving average, and you just make another line over here. So we've got 2 lines, I just connect them. My trend is actually down. So now if I've got a downward trend and I'm trying to go bullish over here, well, look, the trend is down. It's not going to the upside. So what is it that you're actually looking for? Well, I'm looking for an uptrend like this. Now, you might not catch it all perfectly. So how do you go about doing something like this? Well, what you want to do is start seeing at least a turnaround. So if I'm looking at this trend to go bullish here, this would be much better, because now if I just start connecting the dots, and I start seeing this is moving to the upside, right? The angle to the upside versus the angle to the downside, it just makes much more sense. So this is why in this kind of situation right here, we just don't want to go bullish, because we've got a downward kind of trend. If we were starting to see kind of more this upside movement, I could look to be a little more bullish. And here's another example here for you, Cracker Barrel. When you're looking at this, you've got, again, an extended market, and you've got a little bit more on the bullish side. You've got the trend going bullish. However, you are a bit extended, and here there's no kind of clear-cut direction. So we'll mention this one a little bit later as well. But you can see right here, we're a little bit choppy. We're going sideways after the fact. So anyway, it's a little more difficult when you've got some sideways action and you're a bit extended. And even though you've got this bullish movement to the upside, it just makes it a little more difficult. All right, let's go in and take a look at kind of the next thing, and the next big mistake is buying on an extended move. And this is where I wanted to go in and talk about Cracker Barrel as well, and then we'll head on over back to Amazon and Apple. So a lot of people buy on extended moves, like a stock's going up, it continues to go up higher, and you think, hey, this is a great buy, it's going up for quite a while. And this may sound good in theory, but the reality is you're already buying it so far extended, and it could work for a couple of days, maybe a week or two, but after a while, that stock becomes toast and it becomes a problem. And that's just really painful because then you've got a downward momentum going against you because you're just buying it so far extended. So how far in terms of also standard deviations do we want to take a look at? I'll give you a little tip on the options platform as well on seeing an extended move. So let's go ahead and take a look at this. So here, as we looked at Cracker Barrel, you've got an extended move right here. So if we're looking at a moving average, and I'll just give you two big tips on stocks. Most people, what they do is they trade from the moving average. But stocks, what they do is they usually break out from the moving average. So they're trying to do this trade. Like here's the moving average and we're breaking out. However, there's other traders. The stock always goes back to the mean. They trade when the stock comes back into the mean. So stocks can do two main things. They can break out, which is what most people try to do on the trade, or they come back in. So they suck back into the gravity. So everything comes back to the average. So if you remember that, you kind of get an idea of, are we extended? So if we're this far away from the average, that's a big extension. Whereas if we combine it here, that's a lot less of an extension. Take a look at Amazon here. And you can see, like if we look at these spots, they're kind of within average. So you don't really know, are we going to break out or break down? You know, just from that picture view, you don't really know. Here, you can see the stock gets too far extended. So when we go into here, it tries to come back to the average. Then it breaks back and pulls away from the average. Now, look at it right now. If I tried to buy this, like this move looked great. And now as a new investor and trader, I say, yeah, this is the time to get in. The stock's been going up. The problem is we are overextended away from the moving average. So chances are, even if this average starts going up, this will probably come back into it right here, somewhere in there. Eventually, even if it comes back into right here, that's still quite a bit of a pullback. And that's what people just do not get, is that there's going to be an issue with this returning back to the mean. So you're buying on an extension. I'll show you another one here. Apple, look at this. Look at this move right here. Overextension probably will come back. This line is now a little more flat, but look at this move. Look at this run, like 13 days or so, green, straight green, and you're extended, right? So if we kind of measure this move from 151 to 180, and I have a different platform that I also actually prefer to use. I just use this one to make videos. If we go from here to here and we look at that run in about 16 days is a 27-point run. So how do I do this on the option side? So here's a quick tip. If you go to Apple right here and you go to about that 20-day move, they expect that stock to move right here. The expected move is 9.74 or so. So they expect about a 10-point move in about 23 days. Okay, so 23 days, 10-point move. Here, what we've got is in about 16 days, about 27, almost 3 times the move in 16 days. So this move is 2 to 3 times on the standard deviation scale. It's moving much faster than expected. And that's one way to kind of check it with options is you look over here on the expected move on the TD platform, Thinkorswim, and you can see there, right there, the implied volatility is going to be to the left, then the expected move is to the right, and that's one way to check it. If you don't have it, you can use kind of the straddle at the money and do it that way, but that's beyond the scope of kind of this video. So anyway, that's what I want to share with you here on mistake kind of number 2 that people really make is they just buy an overextension. It's just too far extended, way beyond the scope. Let's take a look at number 3 here, a low risk to reward. So check your risk to reward. Is it favorable and do you see potential? If you have a low risk to reward, then you may want to step aside and find another setup. A low risk to reward reduces your probabilities and therefore is not favorable. So if we're starting to look at some of these other trades over here, and we're starting to see, like look at Apple, like my risk now, if this thing does come back to here, I've got a risk over here and a possible reward like up here. So I'm risking that much to maybe make just a tiny bit. It's not a lot, right? I'm just trying to make $2 and I might be risking like 5 or 7. So risk 7 to make 2, it's probably not favorable. On the other hand, if you start looking at maybe a stock like, let's say this, and you start saying, okay, well, if this starts turning around, well, maybe I'm risking this much from let's just say from a longer term perspective, and maybe it can come back up here or up here. Now I'm risking this much to maybe make much more. So look at your risk to reward. Here's Twitter, for example. And if you think about this coming back to the moving average, let's just say I'm risking this much to maybe make a much larger potential. So again, what's your risk versus your possible reward at what level and point, right? So you're going to constantly be checking that out. And if you're looking at option trades, then you'll also compare that as well. Like how much money are you putting on the line versus your reward. If you look at stocks that are overextended on the downside, like here now, you could say, okay, well, my risk is maybe this to come back to the average, but my reward is now that. So reward versus risk, you start seeing, hey, okay, well, now it's kind of like a one-to-one. Maybe that might be more favorable for you. On the other hand, if you look at stocks that are kind of overextended, let's just say they get overextended like this, you're risking this, maybe a little bit lower to be able to come back to the average, right? That's what we talked about. It's coming back to the average. So you're always constantly comparing these things, and a lot of people, they just overcomplicate it from the stand of, I want this stock to continue going higher, but your risk is just too big. So even on an extension like this, you're way up here, but the risk is much greater. So be very careful with this, that you're not overdoing it from a risk to reward, and calculate that, because what is it that you're willing to kind of lose on it. Here we got Lulu, looks great, moving up. Might be risking this much to make what? A little bit more. Remember, when they're too extended, they'll probably pull back eventually. Okay, let's check out the next tip here. And that's going to be plan to be wrong. You won't always be right. Plan to be wrong. And what will you do if it goes against you? So will you have extra money on the sidelines ready to go? Will you cut your position? Will you sit tight? What is it that you're going to actually do? So plan to kind of be wrong in situations. So even though the trade might be set up, it might be good to go. So let's say I've got like this trade on Pinterest. It's good to go. I think it's going to break out. And I think, hey, look, we're consolidating right here, but all of a sudden it just continues to go here, right? If I take the trade early and I believe it's going to go up, but then I'm wrong, what am I going to do? So that's the big question. A lot of people get into stocks and they go into Apple. Yeah, Apple's great. I love Apple and so on. And they love it. And it's like they get in it right here and it's been going up, and for 2-3 days it's great, and then all of a sudden it pulls back. It happens the same with like Amazon. Yeah, it's a big company, or they'll get in it like, let's say somewhere over here. They'll get into the stock over here, and then they get in, and it starts rolling over on them. And then they feel wrong. They feel, oh, I just didn't do the right thing. So what are you going to do when you're wrong? Now, this could have been the next breakout. It could have came up here, came up, and it could have done something like that. Similar to like over here, we did a nicer breakout, but we didn't. So what if you're wrong? What are you going to do? How are you going to set up that trade to counteract that problem if you're not correct? And if you plan for it, then you'll be able to be more cushioned for the situation. Otherwise, what you'll do is you'll say, hey, look, this stock's popping. I'm going to go ahead, buy, way overextended, and it starts selling off. Like, well, might fill the gap. So what am I going to do? Now, on the other hand, if you were short and it starts to keep going up, again, what are you going to do? So most people don't plan for that kind of thing. And it's important that you always think about that. So you either reserve more capital on the side, or you go ahead and, hedge your position and bet. If you're doing, let's say, a vertical spread, you could hedge off things or do things wider or tighter or reduce your capital size. So there's a handful of different things you could do, or stagger your positions in trades. Let's say you got 100 shares, maybe you trade 10 now, 10 later, and then 50 later on. So you're trying to build a position around the trade rather than all at one time. So there's a few things you could do, but just plan that if the trade does go against you, what are you going to do? A lot of people were trading Microsoft right here, and it was going well, and it's going well, and then it starts to pull back. So you got all this clutter over here where a lot of people felt like they were wrong. even though they got in at earlier prices, it seemed good for a while, even maybe about a month or so, and then things just started to kind of roll over. So what would we do if we are wrong? So anyway, those are a couple of the things I wanted to share with you. I'm going to give you a quick little checklist here that you can kind of go through mentally if you want. So when you're putting on a trade, are we on an uptrend? Think about it. Are you moving up? Are you going on the moving average, and is it kind of pointing to the upside? Is the move extended beyond normal? So if you have a stock that's moving up 10 days in a row, has it had a pullback recently or not? If not, it's probably going to pull back. Just probability, it's not going to go to the moon. That's just the fact, is most of them do not go to the moon. Some of them do go for a while, but a lot of times, most of them will pull back. What is the risk versus the reward? Are you risking like a ton of money because the stock is already extended to be able to make a little bit more? Or are you kind of buying on the dip, and maybe risking just a little bit right at support resistance for the next leg or another nice big range? And then what is your plan if you go wrong? So people don't plan that. So start planning those things out, and you'll be much more clear-minded about it. Like if you're wrong, what are you going to do? Are you going to cut your size? Are you going to increase your size? Are you going to stand still, sell calls against it? What is it that you're going to do? So those are a few ideas for you on your mental checklist. Is go through those things. And if you're really serious about like understanding this kind of stuff, then definitely check out some of the courses here that I have on the website. From a technical standpoint, the Swing Trading Full Circle class is really all about technicals. That's on the Traders Fly website. I would highly recommend you check that out. We have a lot of other option courses. If you're brand new to trading or technical analysis at all, Stock Trading Foundation is a really good course as well. Anyway, I hope that helps. Truly appreciate you guys joining me. Thank you so much. Feel free to check out the options training if you're getting into options, and you can see that at tradersfly.com as well. Join the Discord, hop on a live class, or book a one-on-one session. I'm happy to help you guys out, work with you. It's really good to mastermind and plan things together, and I hope to see you there. All right, thanks. See you next time.